Inventory is rising rapidly, more rapidly than any recent July, but the pace of increase has actually slowed since June. This is the third week in a row for 3% inventory gains, down from 6 to 8% over the last few months. So these are early signals for homebuyers and sellers to expect actually restricted inventory for the near future. We're off the record lows, but the trajectory does not look like we'll get back to any normal levels of like 1 million single family homes available on the market anytime soon. We'll share more details in this week's Altos Research Real Estate Market Update. Every week, Altos tracks every home for sale in the country. We analyze all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. If you aren't using Altos market reports with your clients, your buyers and sellers, now might be the time to step up. Go to altosresearch.com and book a free consult with our team because everyone is worried about what's happening right now. They need you to help them see clearly. I'm Mike Simonsen. I'm the CEO of Altos Research, and here's what we're looking at for the week of July 25, 2022. By the way, special note, next Monday, August 1st, I'll be traveling and will be unable to produce the video. I have a couple of trips before the end of the summer, and we'll have to skip those Mondays. The next Altos Top of Mind podcast will be available on Wednesday, August 3rd. That's my interview with Kevin Oakley. We're talking all things new construction, what's happening with the buyers for those homes, and how the new construction will impact inventory this fall. Great conversation, Wednesday, August 3rd. Then back with regular weekly video on August 8th. Okay, inventory. Available inventory of unsold single-family homes grew by 3.3% this week to 525,000 homes on the market. If your neighborhood is like mine, you'll see the difference lately with the yard signs popping up like dandelions. You can see the history here, though. We have 30% more inventory than last year at this time, when we had just over 400,000 homes on the market, but still fewer homes than 2020 at the start of the pandemic, when we were at 640,000, and still 40% fewer than 2019. Our current forecast model projects that the year will peak with over 615,000 homes on the market and end the year at about 535,000. So if the economy tanks, we could see significantly more than that. It's still hard for me to see us getting back to normal levels of inventory, which would be about 1 million homes on the market, unless we hit a really big, deep job loss recession. The rate of inventory gains is slowing now each 2 weeks. So in June, we were adding 6 to 8% inventory per week, and now we're adding closer to 3%. That's still a lot for July. Normally, it might be like 1% per week, but it's slower than it has been, and the trajectory looks to be turning the corner for a peak in September and October before receding for the holidays. In fact, if we look at the weekly changes in inventory, we can see how the forecast probably plays out. Each color here is a year. The bars above the line are weeks when inventory gained, and below the line are weeks when inventory declined in that week. You can see the dark blue line at the far right of the chart has bigger spikes than we've seen in years. The last 3 weeks, though, the inventory gains have receded a little bit. The brown here is the forecast week by week through the end of the year. You can see we have 5 to 6 more weeks of pretty big inventory gains still this summer. I've highlighted also the third week of July back in 2018 and 2019 here, you can see. So we'd normally add 10,000 homes this week, and this year we added 16,000. So bigger than normal, but slowing down from June. For inventory to end the year over 600,000, say, we'd have to have several record-breaking weeks forthcoming, or not have any seasonal decline over the holidays. Both seem possible, but maybe unlikely. I'm an optimist, so that's how it looks to me. But If you have buyers sitting on the sidelines, this implies, yes, they'll have a little more selection, but it doesn't look like it's going to be a ton. It seems unlikely that mega bargains are going to suddenly show up. We have fewer bidding wars, so that's great for buyers. But those people circling like vultures, looking to scoop up deals from distressed sellers. It seems unlikely to have great opportunity for that crowd in the near future. Maybe some, or maybe further out. Speaking of bidding wars, that's one place you can really see the impact of higher rates. When rates are 3%, if you have to overbid on a house by $100,000, that only changes your monthly payment by a few $100. But at 5.5%, that payment change is really notable. So those bidding wars are the first to go. As a result, though, we can see the market price for homes staying relatively stable. The median home price in the U.S. this week is $450,000. That's down just a fraction of a percent from last week. As rates rise, the marginal bidding war ceases, but the ask price stays relatively flat. So because home prices are up 12% from last year at this time, that's another signal that we are likely to see very few distressed buyers anytime soon. It implies to me that sellers seeing a soft market may simply hold back. I suppose that changes if we see a big economic drop. The median price of the newly listed cohort this week rose to $408,000. That's encouraging. I've been on the lookout for signs that the market may be tanking fast or accelerating down. The one place we'd see that, or one of the places we'd see that, is in this price of the new listings. That's the light red line here. As homes start to sit on the market longer, we can see this happening in places like Boise and Austin and Salt Lake City. And especially at the high end of the market, the homes over $1 million, as they sit longer, we'll see price reductions in the active market, and then we'll see the median price of the new listings each week start to discount back a bit. And if it's a lot, then we'll see future transaction prices, sales in the future, those prices will start to decline too. But as of right now, the price of the new listings is declining. It's a seasonal change rather than anything special about overly slowing real estate market. But of course, we do see price reductions climbing. When the homes sit on the market longer than expected, they start to discount. So this is going to continue through end of summer into the fall. If you listed your house in June and didn't get any takers, you're now starting to adjust to find buyers. And in June, we had this big surge of new inventory. So currently, 34.8% of the homes on the market have taken a price cut. Price cuts are still rising rapidly each week and maybe only have slowed just a touch. Next week, we'll be at the most price reductions in several years. By the end of the summer, we'll have 40% of the market with price reductions. See, the dark red line here is just about to break above the trends of the last 6 or 7 years. And this is why sellers right now need to be informed. You don't want to overprice. You don't want to risk it at this moment. There are only going to be more competition and more price reductions for the rest of the summer. So don't get behind this curve. With 2018 as a guide, you can imagine that price reductions peak in October, late October, before the holiday reset. So we have a long way to go on these price cuts before the year ends. If you need to have this type of conversation with your buyers and sellers now, you should go to Altos Research and sign up for the data and have it in your hands and in their hands today. Local data for every zip code in the country. The market is moving so quickly that your buyers and sellers need you to be the voice of expertise. So right now, join us at altosresearch.com. On the immediate sales watch, we can see a gradual trend of fewer and fewer homes selling immediately, fewer bidding wars. This week, just over 18% of the new listings went into contract essentially immediately. I'm expecting this to fall closer to 10% in the coming weeks. Still, we'll find that still well-priced properties, the good ones, the rare ones, still go very quickly. And this is the tail end of the over-hot market of the last 2 years, starting to trend lower. Okay, that's all the data we have time for this week. Next week is an off week for me. No video. Altos subscribers will, of course, get their data on schedule. Back August 8th with the latest video. Hit the subscribe button on the YouTube channel so you don't miss any of the videos when they come out. We'll see you in 2 weeks.